Welcome to the Opening Bell Report.
Welcome back. I'm really glad you're joining us today because we have a truly incredible deep dive lined up for you.
We really do.
Yeah, we are looking at a single, incredibly detailed financial analysis report today. Just one report. But the analysts who put this together, they zeroed in on a number that is it's so massive, so structurally significant to the global aerospace industry, that it essentially forces you to rethink how corporate resilience is actually built.
Right.
And that number is $268 billion.
It is a staggering figure. And what makes it so compelling to dissect is what that level of locked-in capital actually represents in the real world.
Yeah.
Because it's far beyond just a cell on a balance sheet. It changes the fundamental physics of how a business operates.
Okay, let's unpack this. The mission of today's deep dive is to explore exactly why the authors of this analysis are currently labeling RTX Corporation, which you might formerly know as Raytheon Technologies, why they're calling it a screaming buy right now. We're going to look at how they are navigating what the analysts call an aerospace supercycle. And to set the stage for you, let's just look at the immediate market context.
Set the scene.
Right. Right now, the action is incredibly hot. RTX is trading at $202.62.
Yep.
Which is up a very solid 2.52% for the session. But here's the technical kicker. It is pushing hard against extreme resistance at its 52-week high of $206.73.
That's a huge threshold.
It is.
Yeah.
Breaking that line sends the stock into blue sky territory, meaning it breaks past all historical price resistance, and technically speaking, there are just no prior ceilings left to cap its momentum.
And while that daily ticker action is, obviously what grabs the headlines, especially for momentum traders who are just looking for a quick breakout to truly understand the bullish sentiment in this analysis report, we have to look past that surface level price action.
All right, the day-to-day noise.
Exactly. We need to examine the structural advantage RTX has quietly built up behind the scenes. The kind of advantage that takes literally decades to construct and essentially insulates a corporation from standard economic gravity.
Insulates. That is the perfect word there, because that brings us right back to that jaw-dropping number the analysts highlighted. The $268 billion backlog in unfilled orders.
Massive.
This comes straight out of their full year 2025 blowout numbers. But when you conceptualize $250 billion in unfilled orders, it sounds great. But let me play devil's advocate for a second here.
Sure.
A backlog is, at the end of the day, just a list of unfulfilled promises, right?
Sure.
It's future work.
Mm-hmm.
Why are the analysts treating this like it is already money in the bank?
That is exactly the right question to ask, because a backlog only matters if a company has the operational capacity to actually convert it into cash.
Right. If you can't build it, it doesn't matter.
Yeah, exactly. But to understand why the analysts are treating the specific backlog with such reverence, we have to look at the timeline it represents. The analysis report frames this backlog as a massive financial shock absorber.
A shock absorber?
Yes. For RTX, $268 billion translates to roughly 3 full years of total revenue that is already locked into the books.
3 full years. That is wild.
Right. So for a company of this immense size, having 3 years of runway guaranteed means that even if the broader global economy hits a massive recession or real pothole, their momentum just carries them forward.
They just glide right over it.
They don't feel the bump the way a standard tech company or a retailer would. Their factory floors are already spoken for until essentially the end of the decade.
Wow.
The real takeaway here is that RTX has successfully decoupled its revenue from the standard economic cycle. Their moat isn't just their technology. Their moat is their timeline.
That makes a lot of sense. It completely removes that month-to-month panic. You aren't waking up worrying about whether you will find buyers next quarter.
No, you are just focused on execution.
Just getting the parts out the door. And when we look closely at how that $268 billion is broken down in the data, it shows just how diversified this shock absorber really is. It is split into 2 very distinct categories. Yeah. Out of the $268 billion, $161 billion comes entirely from commercial orders. And this is being driven by massive, unrelenting demand for Pratt & Whitney engines and Collins Aerospace components.
Which is a direct reflection of the current reality in commercial aviation right now.
Definitely.
Airlines are flying record numbers of passengers, but they are also dealing with aging fleets and an intense need to modernize for fuel efficiency.
They need new planes.
Or at least new parts. They desperately need new engines and the myriad of interior and avionic components that Collins Aerospace provides. That $161 billion isn't speculative. It is airlines practically banging on the door to get their planes in the air.
Right, so you have this massive commercial aviation recovery driving that first huge chunk, but then you have the remaining $107 billion, which comes entirely from defense awards.
The other side of the coin.
And the analysis specifically notes that this side is being driven by the global replenishment of Patriot missile systems AMRAAMs, and Tomahawk missiles.
What's fascinating here is the sheer power of this dual-engine business model. The analysis report actually refers to RTX as a hybrid giant.
A hybrid giant, I like that.
And when you look at how those two sectors interact, you see exactly why. Consider the geopolitical landscape driving that $107 billion defense backlog. We're seeing a period where allied nations globally have depleted their stockpiles to support various conflicts.
Right.
And now they are engaged in a massive multi-year replenishment cycle.
They are reordering the exact defensive systems that RTX builds.
Exactly. Now compare RTX to pure-play defense contractors, companies like Lockheed Martin or Northrop Grumman that only build military equipment.
Okay.
Those pure-play companies are entirely dependent on government defense budgets. Their revenue ceiling is essentially capped by whatever Congress or foreign ministry decides to allocate in a given fiscal year.
So they are at the mercy of the politicians.
Yes. If defense spending freezes, their growth freezes.
But RTX doesn't have that problem because they play both sides of the field.
Precisely. By maintaining this hybrid model, they capture the high margin growth of the commercial aviation boom while maintaining a highly secure geopolitical defense floor.
It's brilliant.
The two sides of the business physically hedge against each other in real-world scenarios. If a global event causes commercial travel to plummet, say a pandemic or an energy crisis, defense budgets historically rise or remain stable, which holds the company up.
And vice versa.
Right. If geopolitical tensions cool down and defense budgets tighten, commercial aviation is usually thriving, and that drives the growth.
It is essentially a structural hedge against almost any macroeconomic downturn you can think of.
Exactly.
And looking at the financial results of this hybrid model from the FY 2025 numbers, the execution is just incredibly striking. Let's walk through these figures because they paint a picture of a company firing on all cylinders.
Let's hear them.
Total revenue hit $88.60 billion. That is a 10% increase year over year.
Yeah.
But then you look at net income. Net income came in at $6.73 billion.
Which is huge.
It's a massive 41% jump from the previous year.
A 41% increase in net income on an $88 billion revenue base is exceptionally rare.
Yeah, that math is wild.
It suggests that they aren't just selling more products, they are becoming significantly more efficient at building them.
And that efficiency translates down to the individual share level, too. They posted an adjusted earnings per share, their EPS of $6.29, which is up 10%.
Yeah.
And importantly, go back to our shock absorber, that total backlog of $268 billion actually grew by 23% in just 1 year.
Think about that.
So they are completing orders, recognizing $88 billion in revenue, and yet the line of customers waiting out the door has still got 23% longer.
Which is the ultimate indicator of outpacing your own capacity.
Right.
The demand is so ferocious that even running their factories at full tilt, the backlog continues to compound.
Here's where it gets really interesting. Because you cannot fully evaluate RTX's position without benchmarking it against the competition.
You have to look at the peers.
The analysis specifically measures RTX against its lead competitor, Lockheed Martin, trading under the ticker LMT. And the contrast in their current trajectories is pretty stark.
It is very much a tale of two different operational speeds. The analysis report focuses heavily on a concept called top-line velocity.
Let's define that for a second.
Sure. For those of you listening who might be newer to the terminology, when we talk about the top line, we are talking about raw revenue growth, the total sales coming in the door before any expenses are subtracted.
Just pure cash in.
Exactly. It measures pure market demand and market share expansion.
Right. And while Lockheed Martin is currently stuck in what the analysis describes as a mid-single-digit crawl regarding their revenue growth, RTX is growing its top line at nearly double that rate.
Doubled speed.
As we noted, they posted 10% year-over-year revenue growth for the full year 2025. But if you look at the fourth quarter specifically, they hit 14% organic growth.
That word organic is the critical differentiator there.
Oh, absolutely.
14% organic growth in a single quarter for an aerospace giant means they aren't relying on acquisitions.
I didn't buy that growth.
No. They aren't just buying up smaller companies to artificially inflate their revenue numbers for Wall Street. Their core foundational business is fundamentally accelerating on its own merits.
Yeah.
They're genuinely crushing the competition on top-line velocity.
But raw revenue growth doesn't mean much if the business is bleeding cash to achieve it.
Right.
Which brings us to perhaps the most important metric in this entire analysis. The analysts make a very blunt statement here, and it is a crucial insight whether you are evaluating aerospace stocks or your local bakery. The report states earnings can be manipulated, but free cash flow cannot.
It is a foundational truth of corporate finance. We constantly hear about earnings on the financial news. EPS beats, net income growth. But earnings are an accounting construct.
It's math on a spreadsheet.
Exactly. Through depreciation, amortization, and the timing of how expenses are recognized, accounting teams can legally massage earnings to make a quarter look better on paper than it actually was.
Cash is cash.
Free cash flow is the actual cold, hard cash left in the company's bank account after they have paid for all their operating expenses and capital expenditures. You cannot fake cash in the bank.
You either have the cash to pay your debts and distribute dividends, or you don't. And the free cash flow explosion for RTX is arguably the primary catalyst behind this screaming buy thesis.
Without a doubt.
In 2025, RTX generated an astonishing $7.94 billion in free cash flow. That is a 75% increase from the prior year.
Massive.
We are talking about a $3.4 billion jump in pure cash generation in a single 12-month period.
If we connect this to the bigger picture, that specific metric tells us a tremendous amount about the internal health of the company, especially regarding the recent history.
How so?
Well, the analysis points out that RTX is now converting roughly 11.9% of its total sales directly into operating cash flow.
So for every $100 of revenue, almost $12 drop straight into the bank as cash.
Yes.
But why is that specific 11.9% conversion rate so vital to the analysts?
Because it serves as mathematical proof that RTX's historical ghosts have been exercised. If you have been following the aerospace sector over the last few years, RTX dealt with some severe headaches.
The engine recalls.
Yes, they had significant, highly publicized engine recall issues with Pratt & Whitney, and like everyone else, they suffered from severe supply chain bottlenecks.
Right.
When a company is dealing with massive engine recalls, they are bleeding cash to fix those problems. They have to compensate airlines, expedite replacement parts, and run factories on overtime. It eats right into your free cash flow.
I see. So the fact that they are now converting almost 12% of sales into cash proves that those leaks have been entirely sealed up.
Exactly.
Because if the engine recall issue was still a major drag, or if they were still paying premium prices to bypass a broken supply chain, that $7.94 billion cash flow number would just be impossible.
It wouldn't exist. They are operating like a highly calibrated machine again. They have effectively edged out their pure-play defense peers who are actually still struggling with those exact same supply chain bottlenecks.
But all of this acceleration in cash generation brings up the inevitable question of valuation. The market knows these numbers, so everything comes with a price tag.
Always.
When you look at valuation, RTX is currently trading at a trailing adjusted price-to-earnings ratio, a PE of roughly 32x. Now, compared to Lockheed Martin, which trades at a PE of around 30x, RTX is trading at a premium.
Right.
You have to pay a bit more for every dollar of RTX's earnings compared to Lockheed. Is that premium truly justified?
The analysts argue very strongly that it is, and the justification relies on a mechanical business concept called operating leverage.
Okay, let's spend a minute on this because operating leverage is one of those terms that gets thrown around a lot, but understanding the mechanics of it is key to seeing why a 32x multiple might actually be cheap in context.
Think of research and development costs, like building a massive state-of-the-art toll road.
Okay.
Over the past few years, RTX has had to pour billions of dollars into heavy R&D, specifically to develop their next-generation commercial engines.
Building the road.
Building the road. When you are pouring the concrete for that toll road, the costs are astronomical, and it drags down your profit margins in the short term. You're spending billions and not collecting any tolls yet.
Right. The capital's going out the door just to build the infrastructure.
But the analysis highlights that those heavy R&D costs have now been fully absorbed.
The road is finished.
The toll road is completely built. The foundational work is paid for. And because those massive upfront costs are no longer weighing down the balance sheet, their net profit margins expanded significantly in 2025. This is operating leverage in action. Because the road is built, every new car that pays a toll, or in this case, every new engine delivered from that massive backlog, is almost pure profit.
Precisely.
Because the margins are now wider, as they start churning through that $268 billion backlog, a much higher percentage of every single dollar earned is going to bypass the R&D expense line and fall straight to the bottom line as pure profit.
So it scales beautifully.
Yes. So when investors pay a 32x PE multiple today, they aren't just paying for the earnings RTX generated yesterday. They are paying for a company that is structurally positioned to become radically more profitable on the exact same amount of revenue moving forward.
So what does this all mean? If you were listening to this right now and synthesizing all these dynamics, the top-line velocity, the dual-engine hedge between commercial and defense, the massive free cash flow jump, and this newly unlocked operating leverage, where does this point for the future?
Where are we going?
Because the market is obviously a forward-looking mechanism.
The analysts provide management's highly optimistic runway for 2026, and the targets laid out show that the internal expectation is for this momentum to just accelerate.
Lay out the numbers for us.
For 2026, RTX is projecting a revenue target between $92.0 billion and $93.0 billion. That represents another 5 to 6% in organic growth on top of the massive year they just had.
That is an incredible scale. To organically add another $4 or $5 billion to the top line without relying on acquisitions.
It is a testament to the backlog. They are also targeting an adjusted EPS of between $6.60 and $6.80.
Nice, Jim.
And perhaps most critically, given our discussion on the reality of cash, they have set a free cash flow target of $8.25 billion to $8.75 billion for 2026.
Wow.
They fully expect the cash-generating machine to widen its output.
And there is a final, highly pragmatic detail the analysis report points out for investors. While you are holding the stock, waiting for this multi-year backlog to translate into all that projected cash flow, you're actually being paid to wait.
The dividend.
RTX currently offers a 1.34% dividend yield. It is a very tangible bonus layered on top of the capital appreciation potential.
It adds a reliable element of income to what is fundamentally a growth and momentum story, which is a highly attractive combination in the current market environment.
Absolutely.
When you synthesize all of this data from the analysis, the ultimate verdict becomes very clear. RTX is no longer a company playing defense against its own internal problems.
They turned the corner.
It has officially transitioned from a turnaround story recovering from supply chain shocks and engine recalls into a compounding cash flow machine. When you combine that expanded profit margin with a backlog that guarantees revenue visibility through the end of the decade, you have effectively built a financial fortress.
Financial fortress. I think that perfectly encapsulates how that $268 billion shock absorber protects them, while their commercial and defense engines actively drive them forward.
It really does.
It is incredibly rare to see a single enterprise effectively conquer two wildly different macroeconomic sectors simultaneously, while also definitively fixing their internal cash flow leaks.
Very rare.
Well, thank you so much for joining us on this deep dive today. We really hope this exploration into the financials and mechanics of an absolute aerospace titan provided you with some serious mental models for how to evaluate corporate resilience.
It's a great case study.
Understanding the nuances of top-line velocity, knowing exactly why free cash flow is a far more reliable metric than manipulated net income, and seeing how a dual-engine business model creates a timeline moat, these are the kinds of insights that truly give you an edge as an informed observer of the financial markets.
This raises an important question. If a single hybrid company now holds a backlog so massive that it guarantees highly profitable revenue through the end of the decade, how might that kind of immense economic gravity and locked-in reliance reshape the balance of power between private aerospace contractors and the global governments that absolutely depend on them?
Oh, that is a fantastic thought to leave on. A true shift in gravity and leverage. Something for you to definitely mull over as you watch the aerospace sector evolve in the coming years. Thank you again for taking the time to unpack this with us. Keep exploring, stay curious, and we will catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.